It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast. Yes, your daily pulse on the Australian property market from Port Macquarie to Melbourne. We are talking with some of the sharpest minds in real estate to help us cut through the noise and focus on what is really happening on the ground. It is a Friday, it is May the 29th, and if you are inspecting properties this weekend, crunching the numbers or searching for the right opportunity, happy hunting. And happy birthday too if you're celebrating for May the 29th. A couple of singers are doing exactly that. One is an Australian icon and one is a British icon. Kylie Minogue, she's turning 58. And Mel B, she's turning 51. I can never separate out those Spice Girls. Mel B, no, I don't know which one she is. Something famous that happened also on this day, you got to go all the way back to 1953. Sir Edmund Hillary and Tenzing Norgay became the first climbers confirmed to reach the summit of Mount Everest. Now, the federal budget changes are already creating major uncertainty across lending sectors, particularly for property investors relying on negative gearing to support borrowing capacity. Some borrowers, as we've discussed, are discovering their finance position has changed. Are lenders now becoming far more cautious about investor lending and future exposure to residential property? I mean, this is bedding down now, isn't it? There's been plenty of reflection and sucking in the new reality of what has happened. But let's take you on that note to Brisbane and catch up with Alex G, who is the owner of Kingfisher Finance Group. And welcome to you, Alex, to the Real Estate Breakfast. Yes, there are reports of investors having borrowing capacity reduced significantly after the budget announcements, even where buyers believed that they had already been approved with their finance pre-approval. But that has shaken confidence for many Australians entering the market. How concerned should investors be right now about relying on those pre-approvals in this changing lending environment that you are so heavily involved in?
Yeah, hi Craig. Thank you for having me, firstly. And yes, you're right, there has been a few changes of late, a bit of a knee-jerk reaction with some lenders. So I think the investor segment, and we have a lot of mum and dad investors, if you are currently in the process of looking to purchase and you might have a pre-approval in place, it's probably a time where you need to be really cautious when you are looking to convert that pre-approval, because what we've found is that there are some lenders who, when it comes time to moving to full approval, they're changing their position around negative gearing.
Yeah, I mentioned last week that some investors are questioning whether traditional residential investing still works financially for them, and did mention that some are turning away from residential property investing and looking at the commercial property, which is quite a different thing. There's so many things you have to learn about commercial versus residential, which is pretty straightforward.
Yeah, you're spot on there. I mean, typically, a mum and dad investor, residential makes the most sense. There's less complexity. It's an asset they're usually familiar with, particularly if they own their own property as it stands. So for someone to then pivot and look at commercial, there is a bit more complexity involved. Often, you're purchasing in a different type of entity, whether it's a trust or a company. So it is potentially a pathway forward for some people, although they need to be comfortable that they've done enough research and they understand what they're moving into.
Let us know if this is you, if you have decided to get into the commercial space and pivot. Our email address is myrealestatepodcast@gmail.com. Boy, we would love to hear from you and exactly what you're doing around that space. Now, has the Australian investment property model, do you think, fundamentally changed for average mum and dad investors?
I think what we're going to see is a lot of investors will probably shy away from investing in traditional real estate. And I think maybe they'll look to park their wealth more into their owner-occupied property, right? Where they're not going to be as affected, hopefully, longer term when it comes to capital gains and those impacts. I think my client base already, they're looking at alternative style of investing where maybe, they're accessing their equity and they're investing in shares or ETFs, maybe with their financial planner. Again, these are clients that are in really strong equity positions, but they're just not able to afford that investment property without the negative gearing helping servicing.
Yeah, one of the biggest concerns emerging is whether these tax changes and lending changes could worsen Australia's rental shortage by, discouraging future investor activity. And all of this is coming at a time when vacancy rates remain critically low. Fewer investors entering the market may create additional supply pressure, and we need that like a hole in the head, right? So could these reforms unintentionally make the rental crisis even worse? Can it get much worse? Many people will ask.
Yeah, most definitely. The existing investor market, because they're able to keep the negative gearing benefits for those that have been grandfathered, they're probably not likely to sell, right? So we might see that rental stock stays where it is. But in the established markets, given the changes and the removal of negative gearing, there's definitely not going to be as much investor activity. So we'll probably see upward pressure on rentals, although it might be a bit early to tell the full impact of that.
We are talking to Alex in Brisbane. When we come back, we'll talk about newly built properties as well as the Gold Coast and the Brisbane property market. That is next.
Every morning from 6 a.m. across Australia, we deliver you the latest property news, commentary and predictions from Perth to Cairns and from Melbourne to Brisbane, with diverse perspectives from leading industry experts. We deliver the most property podcasts across Australia every week.
And it is a Real Estate Friday. Looking forward to the weekend that is coming up. We are in Queensland this morning. Alex is with me, and there is also growing hesitation, Alex, around newly built property, despite the government pushing investors towards new housing stock. Some investors see construction delays, you've got your higher costs and then settlement risks as major concerns in the current market. Question here is, why are many investors still reluctant to move into new build property despite the available tax incentives?
I think it comes back to supply. Like typically over the last few years, we have seen a lot of first home buyers trying to purchase land and build. And even those people, they're typically waiting 12 to 18 months for land to be registered. And during that waiting period, we've also seen growing construction costs. So by the time it comes time for land registration, typically the budget's blown out. And I suppose those concerns are still valid for investors as well. If they can't settle on land for 18 or 24 months, how can they have certainty as to what that project's actually going to cost them? And another issue we see with this type of property and getting finance approved is lenders typically can't finalise their unconditional approval until closer to land settlement and we can get valuations completed. So for someone to go and buy a block of land today, they're essentially purchasing that unconditionally because we can't actually finalise the finance approval until maybe 3 to 6 months until that land's ready to title.
Right, you're in Brisbane. We should talk about Brisbane and the Gold Coast real estate and what sort of news is coming out around that within regards to how the property markets, both of them, continue showing resilience despite rising investor uncertainty, because Brisbane recorded strong demand across middle ring suburbs, while the Gold Coast luxury market remains active with interstate migration continuing to support these prices. Man, migration for both of these areas are going off. Agents are reporting that buyers are becoming more cautious, however, on finance. And there's this growing concern that reduced investor activity could place additional pressure on already tight rental markets throughout both of those regions. So we come back to that supply issue.
Yeah, you're spot on. I think a big thing driving the growth in both Brisbane and the Gold Coast market, like you mentioned, is that typically it's the owner-occupied buyers, right? We're purchasing in really strong suburbs. Everyone's looking for a premium property. We've always had the demand there. I think on the investor side, over the last few years, there has been a lot of investment into Southeast Queensland in the more established areas. However, that's becoming more and more difficult as prices have continued to grow. And from an investment side of things, it's probably not stacking up anymore. However, the more premium properties and you have the emotional home buyer, they're the ones that are in really high demand, which is probably keeping that growth.
Yeah, and just in terms of the investors from Brisbane, over the last few years, have you seen that appetite for people wanting to invest in the Gold Coast, or are they quite content because Brisbane is bubbling away quite nicely, or do they want a little bit of coverage in both? What's been your experience around that?
Yeah, it's been a good mixture. There's a few of our clients that have relocated to the Gold Coast for lifestyle reasons, like most of the east coast of Australia. On the flip side, there are a lot of investors that are looking, maybe at a unit or a little duplex down the southern end of the Gold Coast. I think it's a mixture. I think it depends on the investor and the client as to where they think they'll do best longer term. However, the demand in Brisbane has still been really strong over the last 12 or 18 months. So it'll be really interesting to see with these changes if that lower end of the market continues to be as popular.
Yeah, I mean, it's just so hard to believe. When I was living in the Gold Coast, 2009, 2010, you could buy yourself an apartment for around about 180,000, maybe even less. And if you were in the areas of Logan, extremely affordable. But that's the living reality that we all find ourselves in 2026. Hey, Alex, great to chat with you on the Real Estate Breakfast this morning and all of that information coming out of Brisbane. Enjoy your Friday and the upcoming weekend.
Yeah, thank you, Craig. It's been great to chat. And I suppose one thing I'll leave your listeners with is just make sure you're doing your due diligence and you're being really thorough with your pre-approvals. And when you're looking to purchase, check in with your bank and broker. We'll make sure you're set up for success.
Whether you're a seasoned investor or a first-time buyer, know your property with us on the Real Estate Podcast.
So I guess the biggest issue that I have with this budget is that it proposes to take away aspiration from so many parts of our country. Young people wanting to get ahead, investors wanting to plan for their own retirement and not be a burden on the country.
That is so true. And off the back of everything that you're talking about, especially for first-home buyers, Australians are starting to question whether traditional housing is worth the financial pressure anymore, which is a fair point.
Well, of course, that's all been stymied now by the budget, and these same people now are deciding that is it really a good idea after all, because not only can I not get those negative gearing benefits, which are valuable to people in higher incomes, but at the end of it, half of my equity is going to be taken off me.
We connect you to the best real estate information across Australia. The Real Estate Podcast.